All right, grab your favorite mug. It's time for coffee with your retirement coach.
Hey, Calhoun.
Yeah.
You still afraid?
Okay. We got phenomenal feedback from that episode. Yes, I am. Our listeners are way more fearful about this upcoming election. Scare level high. We're hearing it. That's why today's episode, we want to talk to you before you sell everything and move to Canada.
Hey.
We want to make sure that you take a look at historical precedences and you really factor in what potentially we're looking at after the results of this election.
Yeah.
So behind the clipboard with me today, we've got Randy. Randy, how you doing?
Doing well.
Nick, how you doing, bud?
Hey, doing great.
Awesome to have everybody at the table. When we're afraid, there's safety in numbers. But again, I want us to dissect this because that's the real response that we're getting. People are seriously talking about leaving the country. They're talking about, hey, I want to sell everything because, if I've got it buried in jars in the backyard, they can't take it. I just want to make sure we bring some truth and some enlightenment so people can have a little bit of peace and have some good next steps in place.
Yeah, man, that's so good. Aaron, it's really interesting if we think about the last time we just saw such a rise in tension and fear, Randy. I mean, like in people's, anxious levels were just so high. We think back to, the coronavirus. We think back to 2020. But do you know what the pandemic, 2020, do you know what that and a Democrat presidency have in common?
This sounds like the setup for a great joke.
Yeah. It's called an 18% rate of return in the S&P 500.
You're not wrong. You're not wrong. Now, can you break that down for us? I know there's a lot of ingredients in that recipe.
Yeah. And so, first of all, I want our listeners to know we are equal opportunity offenders. I'm sure if you tune in for this whole episode, we're going to probably offend everybody. Yeah. But here's the reality. Going back to 1949, if you looked at the S&P 500 and you looked at when you had a Democrat president and you had a split House and Senate, it was an average rate of return of 18.1%.
Wow.
Isn't that crazy?
It is.
Right?
That's the S&P 500.
And that's the S&P 500. And Randy, you know what's really, really crazy?
Talk to me.
If you had a Republican president and a split House and a split Senate, right? So you had it split.
It's going to be a lot different.
Ready? 17.6% average rate of return.
Isn't that
We
crazy?
are talking about a fractional difference.
Right.
So when we really look at the numbers, especially from a market, I mean, this is going back to 1949.
Yeah.
And, the numbers, I think numbers don't care about our feelings.
Yeah.
Right? Math is just math.
Yeah.
But, when we look Morningstar, Bloomberg, that's where we're getting this information. And, I mean, this is real stuff.
We're going to talk about some numbers. And I think for those of you who are hearing this for the first time, if you want the reports that we've shared with our clients and that you can get a copy of that. Aaron, where can we get that?
If you will email us at connect@yourretirementcoach.com, some of this, you got to see it. The visuals are incredible. So we'd love to hear from you. If you've got any questions about the concepts that we put out there today, please reach out to us.
So, Randy, we're going to dig into this episode in a lot more numbers. Like, we're going to, literally talk about actual results. But first, I've got to ask you a question because, I think the question is worth asking. It's, why does this even matter? Why are we even talking about this? Because, you could look at some graphs in that, but why is that important?
I think you're asking this because I'm the old guy in the room. But, I've been investing for a long time, working with clients for now 41 years. And I think what happens is every election cycle, there's a lot of fear that people are exposed to. And today, with social media and the way just media in general seems to be, it promotes, the news at 6 and 11. And today, there is a lot of newsletters. There's a lot of products out there that those who are in the fear business use times like this to scare people into taking action. And I would say disproportionately, the action that they scare them into doing is the wrong action. I mean, with a high degree of probability.
Well, and Randy, I think you have a really, really good example of this. Yeah. I mean, you were recently talking with a contractor. You've got some work going on at your home, and I thought they asked a really interesting question. I know you were a little disappointed with the answer or what he was sharing with you about what he was told to do.
Yeah. So, this has happened throughout my career, but I really thought we were kind of past that point today. So people are wanting to know what to do. And I think the idea that you should take action because of an election, or the other thing that comes up is, there's a war in Ukraine. You might have heard of that one too. And Israel. I mean, there's a lot going on. But how many times has there been a lot going on? If you go back to 1949, what you were referring to, I think we've seen some pretty horrific times.
Sure.
And I remember the last 2 elections. I mean, it was the end of the world each time. But
somebody's always saying it's different this time.
it's different.
It's
As a matter of fact, John Templeton said that was the most scary thing, like that it's different this time. So, these.
Yeah, and really the truth is it's different every time.
Well, it's different every time. But really, the thing about history, if you don't learn it the first time, you get another chance to learn it. I mean, it really does
That's
work
truth.
that way. And let's start with a premise that I think the important thing to remember is investing is counterintuitive. Your natural intuition is wrong.
Yeah.
And it's not you, it's not me, it's everybody. It's the way we're made. And I really think it goes back to that fear, like I'm either going to fight or flight.
Yeah.
And so a lot of people.
To Canada.
To Canada A.
Hey,
Yeah.
but Randy, I mean, just circling us back around. Are you getting there? Okay.
Yeah, all right. Yeah. No, I wanted to go around the block to get there, but I want to give some content. So I think one of the things that this gentleman was sharing with me is his advisor had suggested to him that because of the turmoil that's happening right now, and I'm suggesting that we've seen a lot of turmoil in the past, that what he should do is sell all of his stocks and move into bonds.
Yeah.
And you got to think about that on a couple of different levels. So first of all, what's the indicator that that's a good idea? Like, what is going on? Has the market been really bad lately? And of course, we know the answer, no.
Right.
So apparently, you have to look at the motivation behind that. Is it advice? And is advice based on things like fear? Is that a good way to make a decision? So a question I would ask somebody who's thinking about doing something like that is, how much of the money that you would do something like that with, let's assume that was a right decision to make, and it wasn't. But let's say that was some good advice. If you have an IRA or a Roth and you're mostly in stocks and you sell everything and go to bonds, then the market continues to do well, then you're wrong once. You should have stayed with the market and got the performance that may or may not occur.
Right.
But if you're in a non-retirement account and you've had the enjoyment of being mostly in stocks for the last couple of years and your portfolio is up substantially, and you use fear as a triggering to go to cash or to bonds, then you've got to realize these capital gains. In an upcoming episode, we're going to talk about what capital gains might look like, et cetera, et cetera. But what's the tax consequence for doing that? So I've got to pay 15 to 20% to the federal government in capital gains tax on my profits. So if that was a right decision, I'd have to be right twice. I'd have to be right to pay the taxes, and I'd have to be right that the market was going to collapse.
Right.
So I look at how advice is being given these days, and it really still floors me that people are using that.
Yeah. Well, Randy, I don't know how much of that in our industry is by us trying to make people happy, that people-pleasing element that many people in our industry have. You've got a client who's really upset, they're fearful, and for some people, it's just a whole lot easier to put them in a bond portfolio than to spend the time educating them and leading them and holding their hand and helping them really navigate. It's just easier to say, okay, right?
That might be true to a degree, but that's not what our job is. To me, we're not doing easy, we're doing right. And I've told people I want to have a good bedside manner, but mostly I want to be competent. So I don't want somebody to like me. I've lost a couple of clients because I've had to be honest with them and that they were doing things that was going to hurt them and harm what they said was important to them. But I would rather lose my job being competent than I would be just being a people pleaser.
Well, and that's character. And so I think that some people have that. And then you do have the other side that, you in our industry, there are people that are motivated by compensation.
Yeah.
Because sometimes they will, shift people's assets because they've expressed some kind of fear, worry, concern, doubt, etc. And it is just an easy sell for some people in our industry.
Right. Well, I think there's
buyer beware.
I think there's dinner seminars built on that idea. The bait and switch, the idea that you really ought to be afraid, and we just happen to have the solution. So again, what is competent advice? I mean, history can show us, and as we delve into some of these numbers, that the best thing to do is to have a strategy and stick with the strategy. Have a long-term plan. One thing that we think about when we put together the way our clients tend to invest with us is you should have some money conservative. You should have a safety bucket. You should have a strategy that everything's going bad in the short term. This shouldn't be a knee-jerk reaction. This should be part of an ongoing long-term plan.
Well, and that's the thing. It's a plan. And Aaron, you stick with the plan.
You stick with the plan.
And so, you put together, this plan of, before things happen.
Right.
And so many times, people are wanting to make decisions and do things while they're in the heat of the moment instead of before the event occurs.
Well, you're dead on. So, when I've seen people take action like this, which, again, whether it's motivated by the client or motivated by a salesperson who's trying to earn quotas, and a lot of people don't know that some big firms, if you want to work there, you've got to do a certain amount of production. So opportunities when there is either volatility in the market or something that can cause fear, can cause them to shift the product mix. And if that generates revenue for the firm, they meet their quota, not necessarily in the best interest of the client. But let's look at that whole process of decision making. What is the motivation behind making a decision from one type of asset class to another?
Yeah. Aaron, I had a story about a client, and it's totally in line with what Randy's actually talking about. I remember during COVID, this is a particular client that would call me every time the wind blew.
Oh yeah.
Oh yeah. And we don't have a lot of those. Most of the time, if you're doing the right thing by your client and you're spending time educating them and increasing their knowledge about what they're doing, you live in a lot more peace. Okay.
Absolutely.
But this particular gentleman, he just was really wrestling with the instability. Is that the right word? Unstable. Yeah, unstable instability of the world. During COVID. Okay. Right. I was on my way to jiu-jitsu practice actually during this period of time because we weren't necessarily wearing a mask, but anyway, and I'm in the parking lot.
Were you social distancing?
There was no jiu-jitsu social distancing, right?
Virtual jiu-jitsu.
There was no jiu-jitsu over Zoom. But anyway, we're on our way, and I'm in the parking lot, and I spent about 50 minutes in the parking lot with this gentleman afterward, just trying to calm the fears, to walk him through. Right. Now, keep in mind, the market fell over 30% by March of 2020. It was a really, really unnerving period of time. I get it, right? Yeah. But we were talking about how much profit over a really long period of time he had made and all these really great decisions, and he had gone through really bad times, he's gone through good times, and at the end of the day, everything was working the way it was supposed to work.
Sure.
And so to try to help, settle some things, I said, here are some options, but let's just think about it, pray about it, and, really feel good about any actions. But you don't have to take any action. You are set up exactly the way you should be set up. Well, long story short, about 8 hours worth of conversations went into this, okay? Yeah. And so it was not something that he took lightly. He finally called and said, sell everything to cash. I said, everything? He said, everything. I can't sleep another night. I said, I understand. I'm so sorry. Yeah. He said, it's just, you're probably right. And here's the words that killed me.
Yeah.
When the market comes back up, I might start investing again.
Yeah. It's investing is counterintuitive.
And it's counterintuitive, but and as much as I wanted to say that's
beyond
exactly
logic at that point,
why you should not do what you're talking about, right? And you're talking about being right twice, Randy.
Yeah.
I mean, that's the example. And so before it happened, I let him know he was going to have about a $75,000 tax bill if he did this. So you might be protecting part of your profit, but you're going to have a guaranteed tax bill. Guaranteed.
Right. Yeah, so I think, one of the things that doesn't get discovered until April is a decision like whether it's encouraged by an advisor or the client fear or concerns or strategy, that tax bill is for real. Like that's not optional, But I was going to say, Nick, I think you nailed it. I think the problem with not being educated about this or having a strategy and sticking with the strategy all the way through the project is that if the motivation is fear or greed, that you make a decision like if it's a period of time, this whole behavioral finance, if things are bad, they're only going to get worse. That's what the client was dealing with, the recency of a declining market, and that who knew what was going to happen, and so he'd better take action. And so the motivation was fear. Then what's the reentry strategy?
But Randy, what if Kamala Harris wins? Randy, man, if Trump wins, man,
we're
right.
Canada,
the boxes are packed.
Right? but that's the world we're in right now.
Yeah.
If Harris wins,
reality?
if Trump wins, right? Like, it is the reality of the world and how we're shaping our thoughts around even our money, real life, real talk. This is coming down to our money and our concern over money.
Yeah, but the problem with it is the history does not reward that at all. Like, in matter of fact, it absolutely does not reward that. So what are the real numbers?
Yeah. Well, why don't we walk through the actual numbers? Because I think our audience might appreciate this. And again, if you want access, if you're a member of our audience today and you like access to any of this information, we're glad to email this to you. But, Randy, why don't we start here? Because I think this is really interesting. If we were to look at the S&P 500 total returns during presidential election years, so specifically presidential election years, just like this year. This isn't an average over, the last, 40 years, 60 years, or 80 years. Specifically, this is talking about in an election year going back to 1928. So 1928 to the year 2020, which, again, was the COVID year, right?
Well, hold on, Aaron. Did you know this was an election year?
I heard a little something about it. Okay, all right.
God help us all. So this was interesting. In the average election year, the year that the Republican was elected, in that year, the average return was 15.3%.
Going back to what year?
1928.
Through 23?
Through 1920. 1920. In the year that a Democrat was elected, so if Kamala Harris was elected, that's a 8.5% rate of return. So it's almost a double in the presidential election year if a Republican's elected versus a Democrat. Now, here's what's interesting.
Average, very deceptive, right? Because it could be one over the other.
Yeah, it could be down, right? But here's the thing. If you're trying to time the market based on a Republican win or a Democrat win, and you're trying to play that game, it's dangerous because the average in an election year across all election years going back to 1928 was 11.58%. We had clients, and honestly, it was not as many of our clients as it was the general public in classes that we taught and local universities and a couple of programs that Randy and I speak at.
Sure.
What was interesting is it really was more from them than our clients in terms of the fear, should we put money under our mattress, I'm scared, inflation, the Federal Reserve, and interest rates.
I think it's friend conversations, it's dinner conversations, colleague, outside
golf.
of, so people are really, they know what you do and they start asking questions. And because I think we try really hard, and I think we successfully educate our clients to have a plan in place. A lot of people aren't doing that. So what's happening is they're reaching for advice and they're reaching for, what do I do? And there's a lot of bad information out there.
Yeah, 100%. Now, Randy, here's some observation. We've got to get to this because these are real numbers, and I thought this was crazy. So if anyone's listening today, key in on this. There have been 24 elections since the S&P 500 index began. 20 of the 24 elections, that's 83%, provided a positive performance in the year of the election.
Those are good odds.
83%. No, it's not 100%. That means that there were negative years.
It's probably going to be this year, right?
How many times have people actually thought that, right? But I thought this was interesting, too. When a Democrat was in office and a Democrat was elected or reelected, the total return for the year averaged 15%. Now, I don't know how we would classify this specific year with the Biden-Harris kind of mix-up matchup. I don't know how that plays into it.
You can't do it.
That's below or above my pay grade. When a Democrat was in office and a Republican was elected, the total return for the year averaged 12.9%. So bottom line is, we've got an 83% probability looking back on history, if it was to repeat itself, of a positive market. But there's no telling. I mean, we don't know the next terrorist attack. We don't know the next, big corporate fraud or the next, type of AIG event. Like, we don't know any of those types of things. And again, this is great information. It was, from Morningstar and Ibbotson, and, numbers are numbers.
We don't know that, but we do know what probability looks like.
Yeah.
And
True.
The gentleman or lady that decides that they're going to pull the trigger because they've got a hunch, or they've got a buddy, or they read a newsletter, or they went to a dinner seminar and they're going to do this different action. And if history repeats itself and we have an average year with, it looks like about 80% probability, then they're not going to make up those losses that they take. The tax loss where they sold and had to pay capital gains tax or ordinary income tax. Yeah. And they're also not in the market. Now this doesn't mean that we don't believe in de-risking a portfolio.
Sure.
It doesn't mean that we don't think there are times when you ought to be more conservative or aggressive. I mean, we make changes in the portfolio, but we make it based on indicators. We look at what's actually going on. We call it fact-based. This isn't fact-based when people are doing these things. This is fear-based. And there's a big difference.
Oh man, that's good. That's real talk. As much as we can talk about history, like in an election year, I think it's also interesting is, what about the year that follows? What if our favorite candidate is not elected and it's the other person? What does that look like? So the first year of a 4-year presidency, so we're not talking about the average of the 4 years, just that first year that follows the election. I think it's kind of interesting. I mean, in 2021, the S&P 500 averaged 28.7%. So, I mean, that's not a bad return at all, right? If we look at 2017, a 21.8% rate of return. Not bad. So, we've got a Republican and a Democrat elected during this period of both of these periods of time, both north of 20%. Going back 1977, in the first year that followed, we had a Democrat elected. It was a negative 7.2%. In 1981, we had a Republican elected. It was negative 4.9%. The reality is, if you looked across, the majority of these years are positive. Mm-hmm. However, there was really no radical difference between a Republican or a Democrat being elected and what that next year actually showed us.
I think that's what our listeners need to know. That if their candidate does not get elected, unlike what the media may be producing today and the newsletters and the social media experts, so-called experts, is that it is not doomsday because your person that you thought ought to be president didn't get elected. That this is a very robust economy. There is a lot that goes into it. It is, there's a House and there's a Senate. So there is a lot of things that have to come into play. And the fact of the matter, I think the big key that we need to take away is we feel this way as a firm. We talk about this behind closed doors. We've got to help our clients win no matter who's in office.
Yeah. That's the thing.
I mean, we've got to help our clients make smart decisions and help them take advantage of market disruptions, different election years and that. But we don't drive the decision making out of fear. And we recognize the fact that investing is counterintuitive. Yeah. So putting together a strategy that can help people with confidence be educated about this and stick with the plan, stick with the course.
No, Randy, I love that so much because no matter what the laws, the interest rates, the political leadership, do you have a plan in place and are you sticking to that plan? It's huge.
It's good. Good stuff, Nick.
Yeah. So I think for our audience today, if they were to have any big takeaways, it really is what you just said. Stick to your plan, stay the course. But, sometimes for people to actually do that, sometimes you need accountability. Sometimes you need a partner. Sometimes you need someone to collaborate with. And that's really what your retirement coach is all about. It is helping somebody, stick to their game plan. You might be down in the game, right? But if you stick with the plan, you follow the plan, you'll probably end up scoring.
Right.
So it is really go Dogs. It's really had to. Horns down, go Dogs. But we had to really stick to the plan with the client because sometimes left to our own devices, we won't stick to that plan.
Well, I think that's natural. I think human nature is, fight or flight, like I talked about earlier. I do think what's unique about some of the things that we do as a firm, which not everybody's looking for, is really that ability to turn the risk up or turn the risk down in the portfolios so that we could take advantage of the differences of seasons. And as we enter fall, and it's really been fall, here in Georgia the last week or so, that change of season should remind us that the economy does change. It doesn't change by a political election. It doesn't, change because there's a war or something like that's going on. But the natural changes in the seasons of the economy, the way the market works. So there are times when it'd be better to be growth-oriented or value-oriented or, more concentrated on safer equities or more concentrated on more traditional bonds or fixed income or short-term debt. Those things happen because the seasons change. And what we want to do is make modifications and changes that are in line with what's actually happening. And we don't want to get ahead of it and pretend like it's not going to be that way or make an action or a change because somebody had a report out that suggested to be fearful or scared or that something, the sky is falling.
No, absolutely.
It's good.
If you read that headline, if you talk to that friend, what we want you to do is to realize, yes, get in front of a financial professional, seek wise counsel, and find out, one, could I do this? Two, should I do this? Because you don't know what they have, how long they've had it, what the tax repercussions are for them. We know about ourselves, and we want to take ourselves in front of those people that we trust, those financial professionals, and lay it all out there. Much like we get in that paper gown in the doctor's office, just share it all and then get good advice. And if you hear something like the tradesman.
Yeah. Well, I think, Aaron, the purpose of the gown is to cover it all.
And I'll be honest with you, Aaron, if we're going to be talking about paper gown, don't wear that into the office.
Okay, listen, number one, we celebrate all wins as long as those colleges are in the SEC. Two, you know what I mean. Both of you, settle down. We're trying to wrap this thing up, land this plane. Hear me. Hear me. You're the best you, and you would be a terrible whoever your buddy is. So get in front of your financial professional. Be honest. Be transparent. But like Randy said, the tradesman that was in his house, if you went in with a certain feeling and you feel like they agree with you too much and you are expecting a little bit of pushback and you are expecting some other things, it is not wrong to go to someone else. Go to another CPA. Go to another financial advisor. Make sure that what you heard, if something feels a little off or feels a little too good to be true, don't just accept that out of hand.
Yeah. Get wise counsel.
Get wise counsel.
Stick to the plan.
And stick to the plan. And don't be that afraid. I mean, a little bit is okay. It's that kind of month, but history doesn't necessarily repeat, but it's a good teacher. All right, we got to get out of here. Listen, thank you so much for being with us today. It is scary. It can be terrifying at times, but you know what's not scary is the internet. Get on there, email us. We can send you the data that Randy was talking about. If you've got any questions for us that have to do with the election or anything else that you've heard on our podcast or something that's affecting you financially, professionally, we'd love to talk about those things on a future episode. Reach out to us at connect@yourretirementcoach.com. But as always, and most importantly, thank you so much for being here and being coachable. We hope you enjoyed today's show, but you may have questions for our coaches, and they can be emailed at connect@yourretirementcoach.com. If you know someone that needs to hear this episode, we encourage you to share it. As a reminder, the content of this podcast is for educational and entertainment purposes only and should not be construed as advice. On behalf of our coaches, we want to thank you for listening and for being coachable.
Yeoman's Consulting Group, a registered investment advisor YouTube channel based in Marietta, Georgia. We strive to provide comprehensive wealth management services for every stage of the journey. This platform is solely for informational purposes and is not offering advisory services or sales of securities. Investing involves risk and possible loss of principal capital. Comments by viewers or recognitions are no guarantee of future investment outcomes and do not ensure that a viewer will experience a higher level of performance or results. Public comments posted on this site are not selected, amended, deleted, or sorted in any way. If applicable, certain editing of personal, identifiable information and misinformation may be deleted. The opinions expressed herein are as of the date of publication and are subject to revision due to changes in the market or economic conditions and may not necessarily come to pass. This podcast was filmed at Podium Studios at Marietta Square. Grow your business with turnkey, professional quality podcasting, live streaming, and online events. Don't worry about editing. Don't worry about anything. Just come in and record. Learn more at thepodium.studio. Step up to the podium.